Thanks to recent consumer protection legislation, owner-occupied has become a dirty word in the private lending space. If you are out there trying to help people get loans on owner-occupied properties, you may be pretty frustrated thinking, where the heck do I go to these things? Maybe nowhere. Well, the good news is there are options. Today I'm going to tell you exactly how, why, and when you can do a private loan, or we could do a private loan on an owner-occupied property, and we can all make some money together and help people. All right, so a little bit of background. Dodd-Frank. Dodd-Frank is a big bill. A lot of things happen with Dodd-Frank, so I'm not addressing the whole legislation, but out of that came the whole Consumer Protection Agency and a lot of different things that had to do with how mortgages were done. Now, we probably needed it. The heyday was pretty crazy, and it did cause a big catastrophe, but some of the impacts of this legislation have been very difficult for private lenders. All right, and because of that, it's made it super difficult to do owner-occupied properties. And by the way, if you're looking at the picture here, just as a side note, I always think it's funny when they do these bill signings, and you got a bunch of guys or gals standing on a stage just staring at somebody. I don't know, it just looks a little silly to me. But whatever, side note. Okay, so can we do a loan? Can we do a loan, and you with us, can we do a loan on an owner-occupied property? All right, well, let's first of all touch on what the heck do I mean by owner-occupied property, and why can't we normally do it? And then what can we do? So, owner-occupied property, what does that mean? In case it's not obvious, owner-occupied means you're living in a house that you own. So, right now, if you own your own home and you're living in it, it's owner-occupied, right? The government passed lots of laws, consumer protection laws, which protect you as a homeowner. Awesome, great for you as a homeowner. But as a lender, it creates all sorts of crazy risk. I mean, all the mortgage lenders out there are complaining about the laws, frankly. That's just what it is. Everybody complains about stuff that restricts them, whether it's good for them, whatever. But private lenders especially scares the pants off them. There's all these laws about how long you got to wait, how you have to be able to prove someone's ability to repay the loan. Prove it. They literally have to prove that you can repay the loan based on debt service ratios and all sorts of stuff that if you're watching normally, you know, we don't get into, right? We look at the value of the property. We lend on the value of the property. We don't give a hoot how much money somebody's making or isn't making. You know, you got business owners who are hiding money under the mattress, not reporting it. That's important for some people. It doesn't matter to us. So it makes owner-occupied properties very difficult for us to lend on. Fortunately, there is a way around it. There is a loophole or a carve-out or a caveat, or it's not really a loophole, it's just an exception to the rule where we are still able to help people. That situation is when 51% or more of the loan that we're going to be giving is specifically for business purpose, right? And there's some ways that we validate and prove that. You can't just make it up. But with that said, it's not that difficult to prove as long as the numbers work. So owner-occupied properties are going to work as long as the numbers work. While you're watching this, if you have an owner-occupied property, you got a situation, feel free to put it in the box. I will, in a couple minutes, I'm going to go through the math and show you how to break it down, and I would love to have some real examples, so put it in there real time, and we'll do this. All right, but let's jump into what does it mean, business purpose, right? So the money that you're pulling out of the property, and when I say that, you're not going to be using this to buy a home that you're going to live in. So for acquisition finance on an owner-occupied, that's not going to happen, right? Because that is purely personal use. If you're buying the house to live in it, that's personal use. But we're talking about business purpose. So let's say you're talking to a business owner who owns a property, they live in it, and they want to pull some money out to put it in their business. Awesome. This is the main reason I got into real estate lending is in doing business lending in the past, we came across business owners all the time, had a lot of equity in their house, and they wanted to put it in their business. Great. I was looking for a way to do that for years, and we finally found it. So business purpose means they're going to be putting that money into their business. You might be thinking, what qualifies as a business? If I am a real estate investor and I have an LLC and it's a real estate investment company, I'll dig into that a little bit on some of the exceptions, but in general, if you have a business, you're filing business tax returns, and we can put the money into that and we can show that, then this is going to be considered a business purpose loan. The borrower is going to need to sign what's called a business purpose affidavit. This affidavit is them stating unequivocally it is for business purpose. You guessed it. I have an example of one. They are going to be different in every state, so it's not always going to look like this, but I just wanted you to see an example of one from a loan that we did. Notice there's a bunch of caveats, like on the bottom, line 4, it says, no part of the proceeds of the loan are intended to be used for consumer purpose except the following, and then it allows you to put some exceptions. But above, in handwriting, not just agreeing to, you got to write out, this loan is for my business and the amount of money. So it's going to be, the borrower's going to have in their handwriting. If they ended up lying, it's going to be bad for them. It's not going to be bad for us, right? So what are some examples of personal uses that are not business purpose, right? So let's say somebody lives in a house, they got a home loan, maybe they're in bankruptcy and they need a bankruptcy bailout or foreclosure bailout, and it's just the house they live in. They're basically looking to refi the house. That is personal use. That's not a business use. Let's say somebody got way behind on their personal credit cards. They want to pull money out of their house to pay off their personal credit cards. That's personal use. Say they got personal tax liens. They want to pay those off with money from the house. That is personal use. Those are all pretty clearly personal use. Now, of course, you may say, oh, I have a business. These may be personal credit cards, but I used all the money for the business. That might qualify. Might have to dig into that a little bit. That's where it starts to get a little bit tricky. Rick is asking, does a home-based business qualify? Excellent question. I'm going to dig into that in a little bit because that's one of the kind of tricky ones that we are going to touch on. But let's do the math. This is the magic equation, the one thing you really have to understand to know if you're going to be able to do a loan on a business purpose loan with us on an owner-occupied property, all right? So, I always love to use a $1 million loan as an example because the math is so simple. So let's start with a $1 million property. So a business owner comes to you, they own a house, they're living in it, it's worth $1 million. The maximum loan, if you've been watching this a lot, it's a single-family residence. Max loan we could do is about 60%. That's a $600,000 loan. So if that house is owned free and clear, awesome. They can get up to $600,000. They can put it into their business, no problem. We just talked to somebody recently who's starting a franchise, owned a $2.4 million house, free and clear, wanted to pull $1.5 million out to put into his franchise business. Awesome, no problem. That's pretty straightforward. Now, when it starts to get a little trickier is when they come in and they have a first mortgage. They have a mortgage, right? They bought the house with a mortgage. So let's say it's $1 million house, and our max loan is $600,000, and that the 51% rule says out of that $600,000, at least $301,000 needs to be for business purpose. That means the maximum first mortgage they could come to us with is $299,000. Let me know if the math isn't making sense because I can dig into it. I can see how it can get confusing. So somebody comes to us with a first mortgage of $299,000. We need to give them a new loan that's going to pay off their first mortgage and give them new money. The new money, more of it needs to be for business purpose than personal. That personal, remember, refinancing houses, personal use. So these numbers here, I put $301,000 for business, $299,000 for the mortgage. I have found this is the single biggest reason these don't work. A lot of times people come to us and say, hey, I got this $1 million house. I have a $750,000 first mortgage. I got $250,000 in equity. What can I get? Well, unfortunately, the answer is nothing from us. There may be other lenders that lend based on credit and everything. We don't lend that way. That's not something we can do. And just remember, LTV is based on the total value of the property, not the value of the equity. We're not giving a loan on the equity. We're giving a loan on the total value. So, again, we got $1 million property. Let's say somebody comes to us and they have a $350,000 first mortgage on the property. That means they're already at a 35% LTV. We would have to give $351,000 for business purpose while refining the first. That means the loan would have to be $701,000. Unfortunately, now you're at 70% LTV. That's outside our guidelines. That is not going to work. So if you're talking to a business owner and they own their house, then some pretty quick math, they need to no more than 29% of that property can be collateralized by first mortgage if you want to be able to do this. If the numbers work, though, then that is awesome. It's something we can do. If you got questions or you're not sure, feel free to put it in. I can go over that again. It's just basic LTV. Now we're going to get into some of the other situations, like what Rick was talking about. Here are some of the other examples where it can be an owner-occupied property and we need to determine if it's business purpose. First one is mixed-use properties, right? Let's say somebody lives in a property and works in the property. Easiest example would be a farm or a bed and breakfast. Now, this is a totally different rule, which is going to change state by state. This is some of the stuff that is regulated and different in every single state. So unfortunately, I can't give you a blanket answer. It's generally going to come down to what percent of the property is owner-occupied versus used for the business. And in some states I've heard they don't want to see more than 20% of the property being personal use versus business. How do you calculate that? Let's say it's a bed and breakfast with 6 rooms. One's occupied by the owner, 5 are occupied by, bed and breakfasters, people that are staying there. That would potentially qualify. But if it's only a 4-room bed and breakfast, then it wouldn't. Right? Let's say somebody has an Airbnb where they rent out 1 bedroom and they're trying to put it off as a business purpose loan. Sorry, that's not going to work. That's not going to make the numbers generally, although it does fluctuate state by state. All right, so mixed-use properties can be a little tricky, and we need to give you a state-by-state answer on that. Here's another one. I've seen a lot of people say, okay, well, I live in the property. How about I sell it to my son? Right? Let's sell it to my son. Can you give the loan to my son to buy it from me, and I'm going to keep living in it? It's getting into some pretty tricky territory, and I don't want to, probably the answer is going to be no in most circumstances. We do have, I happen to know that we did do something like that at one point where it was more of a sale-leaseback. They sold it, they sold the property to someone else, leased the property back and kept living in there, and then pulled the money out to put in their business, so there was business purpose versus also the sale. It's a little tricky. So I can't give you a hard and firm answer on this, but I wanted to do this show to get onto the other side to really talk about the 51% business purpose, because we, as a lender, have gone back and forth on this a little bit, and I want to make sure that we're super clear. Owner-occupied for business purpose is all ahead, go, as long as we can clearly demonstrate that 51% is for business purpose. Now, the last thing I want to touch on is what if somebody is lying to you, right? When we go through the process, they may say, oh, this isn't the house that I live in, but we have ways pretty easily to figure out if that's not true. We don't necessarily send somebody out to drive by the house to check, but there's public databases where we do background checks and we can do research. So in general, we're going to know if somebody's fibbing, and that's not going to fly, so don't bother trying, please. But in the end, if you go through the steps to clearly defraudulent, lie to us, there are going to be enough steps in there that if it ends up going through, it's the borrower's problem, not ours, because we will have covered our bases. So today's show is relatively quick. I just wanted to make sure to get out there very clearly that we're doing owner-occupied properties for business purpose. So if you got them, let's do it. We're happy to accept them. In the past, I have said no. I have said, boom, pump the brakes. We don't want that. The reality is, internally, when we fund one of these loans, we normally can't sell it off to investors. So we're going to be a little more critical than some of the other loans because we know we're going to be holding on to these things. Our normal process is we fund a loan, we sell it to private investors. This one, we're not. We're going to have to sit on it. So we're going to look at it a little more closely. But with that said, we're wide open and ready to fund owner-occupied properties for business purpose. And that is it. Any other questions, feel free to let me know. But lend to it. We're the lender, and we're going to be landing on owner-occupied properties, and we're happy to do it with you. So that's it. Darren, you got anything to add?
Oh, you just always sort of thing. So, are you going to be able to do single-family residences with this?
So owner-occupied, I sort of assume people understand that if you're occupying the property, it's probably a single-family residence. So definitely yes on the single-family residence, because if you're owner-occupying a commercial, like a warehouse, then I don't know, it's a little weird.
So does the Occupy movement also work for this? Or if I'm squatting in place, can I take it over?
You can squat wherever you want. I don't think you have any legal right to get a loan on it, but probably won't get through title. But
it's just the small things. It's just a small thing.
Whatever you could do. I'm going to say, just on a side note, we are getting a lot of applications for the 100% CLTV financing, and good work. Keep them coming. I probably put out 20 offers over the last couple of weeks just for 100% CLTV financing. If you don't know what I'm talking about, go back and watch the show. It's clearly hot. We're putting out a lot of offers, and people are really interested in it, so that's awesome.
I know. I get the emails every single time you send one out. It's just taking over my inbox.
Right. We got a lot of offers going out, so we're loving it. We appreciate the work you're doing on that. Marcy is asking, thanks for the question. She's saying, can you even finance a single-family residential condo? Right. So doesn't matter what it is. You can tell me it's a log cabin, an RV park, bed and breakfast, whatever it is. If it fits the 51% of fund proceeds are going to business purpose, then you are all ahead go, right? The only caveat is some of these live, work, mixed-use properties where let's say you're refining the property, but you live in it, but it's business purpose. We really need to confirm with our attorneys because it's different state by state, and so we're going to have to dig into that. But yes, condos, mobile homes.
I have a question.
Great.
So what about leased land? If the property is on leased land, can the loan still go through?
Okay, so let me break that down. I know here in Irvine, there are builders that build buildings that they own the building, but the land is leased. I don't think we're doing loans on...
it's one of
that one
those.
hasn't come up. I hesitate because we do condos. From condos, you don't own the land. But we're going to need to look at the term of that lease, and the lease needs to be way longer than the term of the loan, obviously. Good question.
So my condo complex actually owns the land, so it's not leased land, but the HOA owns the land, and we pay $1 every year for a rental or the lease, but the HOA owns it, and we're the HOA, the property owners.
Okay, yeah, that would be fine as long as you're using the funds for business purpose. You're going to go start a business?
I have an office in my I do have an office room, but currently it's being used as a second bedroom for my sister-in-law.
Okay, great. All right. All right, we got another question from Stan. How about if you live at the apartment building that you want to finance? Awesome. Okay, so that would fall into the sort of mixed-use scenario. And it's going to come down to the percentage of the property that you occupy. And as I mentioned before, this is going to vary state by state. But in general, if it's like a 10 or more unit condo complex, you're probably fine, or apartment complex, you're probably fine because you're occupying such a small percentage of that it's pretty clearly... I know that if you have over 4 units, there's different zoning. So probably over 4 units, you're good. With that said, we'd always want to review it with our attorneys to make sure that we're doing everything above board and legal because nobody wants to tangle with the Dodd-Frank. That's no fun. They got some ugly laws which are not nice. All right, so unless there's more questions, we'll go ahead and wrap it up for the day. We look forward to getting your owner-occupied submissions. Just remember to do the math, 51% owner-occupied. And remember, you can run up on that pretty quickly. In general, if 30% of the property is in a first mortgage, on an owner-occupied property, it's not going to work. It needs to be 29% or less. And even that is pushing the edge of the envelope. You should probably be thinking 25% or less of the value of the property needs to be in that first mortgage for us to consider refinancing it. Free and clear, though, is great, and we'd love to do those. All right, everybody, thanks for coming on. If you're new to the show, subscribe. You've been here a long time, subscribe anyway. If you've already subscribed, thank you. You're awesome. Like the video or do whatever you want to do. What I really care about is you succeeding as a finance agent and hopefully us doing a lot of deals together. See you next week.